Welcome to Private Asset Management's Week in Review. Today is Friday morning, November 4th. I'm lead portfolio manager Dillon Hakes. Been out of the office for a couple weeks, but glad to be back in the hot seat.
And I'm Chief Investment Officer David Allen. Good to have you back, Dylan.
Thank you. David, we had a very eventful week this week. We had a Federal Reserve meeting. We've been talking about it for a number of months. This is sort of the hot topic for the market. It seems to be what's been driving markets. What did we learn from the Fed this week?
So the change in policy was largely expected. We did get a 75 basis point increase in the Fed funds rate. That was what we had expected heading into the meeting. A lot of the focus ahead of that, though, was on some of the communications that would come out around the Fed's policy change. That comes out in the form of the policy statement as well as the press conference with the Fed Chair Jerome Powell. On the statement side, some of the changes in the language that the committee used suggested that they were perhaps more acknowledging about the cumulative effect of the rate increases we've seen so far. This is the fourth consecutive 75 basis point increase. Total cumulative change in the Fed funds rate this year is 375 basis points. So, the changes there are pretty significant. And I think the committee was acknowledging that change is likely to have an impact on financial markets and the real economy just in and of itself, regardless of where that level is currently. Just the cumulative change is going to have an impact. They also noted that something that everyone knows, which is that monetary policy tends to have a lagged effect on the real economy. And so by acknowledging those two things in the policy statement, I think there was some suggestion that they were leaning towards slowing the pace of rate increases in the future.
Speaking to that, what did we learn from the meeting notes, from the press conference about the future policy? Did they change their expectation as far as where the path of rate hikes is going to go, where the terminal rate is?
So yes, that was the other piece that came out in the Fed Chair Jerome Powell in his press conference, was that though they may be proceeding more slowly in the future, they think that we're likely to see the terminal rate, the top rate that the Fed will reach in terms of its rate hikes during this cycle, may be higher than what they expected in September. And so it's a bit of a give and take in terms of the communications that came out this week from the Fed. We're perhaps proceeding more slowly, but we may be going further than we thought just a couple of months ago.
What do we interpret from that give and take? On one side, they're potentially going to go farther. Interest rates may end up higher than we originally thought. But on the other hand, they're going to take a lot longer to get there. So one is good, one is potentially negative. What do you take away from that?
So I think I see it as probably less hawkish than I think certainly the market has taken it over the last few days. It certainly is, I think reasonable to suggest that, as we're approaching what is likely to be the terminal rate, not exactly sure where that's going to be, I think it makes sense for the Fed to slow down, to proceed a bit more cautiously to avoid a policy mistake. I guess one of the big positives we can take away from the meeting this week is that the Fed is acknowledging that it needs to be a bit more cautious to not sort of race towards that terminal rate, but approach it more slowly and to try to avoid a policy mistake and as best they can preserve the expansion in the U.S. economy.
The other piece of big economic data we actually got this morning was the employment report. The Fed is fighting very hard against inflation, and a component of that is the employment situation and the very tight labor market that we see here in the U.S. What did we learn from the jobs report today?
So I think a couple of things, and just as a reminder, that the jobs report is actually two different surveys. One of establishments, one of businesses, and the other of households. On the establishment side, that's where we get the payroll numbers, and we did get a slowdown month over month in payroll gains. It was more than expected, but again, a slowdown on a month over month basis. On the household side, that's where we get some of the unemployment data, including the unemployment rate, which actually increased to 3.7% from 3.5% in September. I think that's one of the reasons we've seen the market perform relatively well today after this data came out, is that we're seeing that unemployment rate increase. We're seeing signs that the Fed's rate hikes thus far are having an impact on the economy, particularly in the labor market. On the other hand, we continue to see wage growth that is inconsistent with the Fed's 2% inflation target. And that's something that's going to be continually worrisome to the Fed and to policymakers as they're planning future rate increases. They do want to get that wage growth down to something right around 3%, which would be more consistent with the 2% inflation target.
Turning to markets, obviously this big economic news and economic data that we've gotten this week has affected markets. We're coming off of one of the best months we've seen in markets in a number of years. How are markets digesting this economic news? How are they digesting potential change in Fed policy and what we've seen this week?
Yeah, it's something I alluded to before. I mean, certainly after the Fed meeting, the market took this as a hawkish, set of communications. There was certainly, over the last couple of weeks, what we have seen in U.S. equity markets in particular is this expectation for a Fed pivot. We had seen some signs of weakening in economic data, that the economy was slowing. And I think after the Fed statements, though there was some give and take, as we mentioned, certainly that the market took this as a sort of a call off of that expectation for a pivot, and that the Fed is going to continue to increase interest rates. And we've seen that reflected in equity market performance, but also in expectations for interest rate increases. So now the terminal rate expected in mid 2023 is up over 5%, a little bit higher than 5.1%. Approaching the highs that we've seen here recently. So, I think that expectation for a pivot is basically off the table now, and markets are now more accurately reflecting, I think, where the Fed is headed.
David, the other big piece of news or the big event that has been driving markets of late is we're just finishing up the heart of earnings season. What have we learned from companies that have reported earnings about the state of the economy and the state of big companies in the U.S.?
Well, you're right. I mean, so we're really into the home stretch now in terms of this Q3 earnings season. About 429 of the 500 companies in the S&P 500 have already reported. I think in general, results have been better than expected. Before they came out, we have seen surprises at the overall level. Growth, though, has been a bit weaker than what we saw in the second quarter, both top line and earnings growth. So top line sales growth overall in aggregate for the S&P 500 has been low double digits. Earnings growth low single digits. Remember that a lot of that top line growth is being driven by the energy sector, which is seeing some nice growth year over year just because of the increase in energy prices. Also, that sales growth is largely going to be impacted by inflation. So for these consumer exposed businesses that are passing on higher costs they're seeing to their consumers, that's driving some of the sales growth we're seeing also. In terms of where we're seeing some weakness, I mean, because there certainly is some weakness that's coming out in these earnings, they tend to be in the more tech-exposed areas. A lot of the communications sector, the social media companies, those are obviously tech-exposed. They're seeing some weakness in digital advertising sales. Financial companies, so the large-cap banks are seeing, a lot of their investment banking activities are falling off because of the economic situation we're in, and so they're seeing some lower sales coming from those portions of their business. But outside of that, I think we're seeing earnings and sales holding up fairly well, and again coming in better than what we expected before the earnings season began.
David, you mentioned the situation with large cap tech. We've noticed the disparity in performance with a lot of these large cap tech stocks, and how badly they've been hit after reporting earnings, after providing guidance going forward. One component of these earnings calls that we've heard, and it seems to be a repeating message across a lot of different firms, is the idea that they're putting on hiring freezes, that many of these large companies are laying off employees. We've talked previously about the idea that during the pandemic, a lot of companies with supply chain issues double ordered inventory items that they weren't able to get. More recently, a lot of those items have been delivered, and suddenly companies are left with a glut of inventory, an excess of inventory that they now have to work off. It feels a bit like the same thing has happened with employees. A lot of these tech companies were hiring aggressively for this, stratospheric growth during the pandemic, and suddenly they find themselves with a growth picture that is not quite as rosy, that's not quite as positive as they had previously hoped. And a lot of employees that they've hired, without the growth to potentially support the need of having those people on hand. Is that what we're seeing? Are we seeing an excess inventory of employees?
I think to some extent that's right. I mean, certainly a lot of these, tech companies and tech adjacent companies saw a huge increase in demand during the pandemic as people were locked in their homes, or businesses were transitioning to more remote work. There was a lot of demand for those services, and and those companies really hired into that increased demand. And so, things are different now. The economy is moving away from goods more towards services. People are getting out and about more, and so demand is not quite as strong for those areas. And I do think that's fueling, that reduced demand, is being confronted with a still very high cost base. And I think to some extent we are seeing these companies freeze hiring or actually execute some layoffs to bring those costs down in line with where they're currently seeing demand for their services.
How long is the lag going to be before we see, a lot of this is anecdotal at this point, but how long until we actually see it move on to the employment data that the Fed looks at and will change our outlook going forward? Are we actually going to see these layoffs affect, monthly job gains?
I think we're already beginning to see it. I mean, we have seen a big slowdown in the pace of non-farm payroll gains. Unemployment is still very low, but it did tick up in October from 3.5% to 3.7%. And so, these layoffs are, again, anecdotal. They are not, particularly large in the scheme of the overall labor market, and they seem to be relatively confined to, again, tech and tech adjacent companies. But I think when you couple that with some of the other labor market data we're seeing, I think there's maybe some perhaps early signs that we are getting that better balance between labor market demand and labor market supply that the Fed is looking for as it is hiking interest rates.
Turning to next week, David, what do we have on the agenda?
So, a quieter week than what we saw this week. I mean, I think this is one of the more consequential weeks of the autumn season in terms of what we saw the last 5 days here in the U.S. Next week, we do have CPI data. That's going to be a big report, something that's certainly going to have an impact on the outlook for the Fed ahead of their December meeting. It's the first of 2 CPI reports before that December meeting, so we'll have 2 CPI reports and an additional labor market report after what we saw this morning. So those are going to be important, again, leading up to that next Fed meeting. But also we see consumer sentiment. I think a lot of focus is going to be on consumer inflation expectations, continuing to monitor those very, very closely.
I do think the CPI report next week will be something that's very closely watched. Obviously, everything that we've been talking about and everything the Fed is doing revolves around inflation, and I think it'll be very interesting to see how the data comes out for October. The other big piece of eventful news next week will be the midterm election, which I think most of our viewers and our clients are aware of. It's something that we get asked as portfolio managers all the time from clients about our expectations for the midterms and what we think, how that'll affect markets. I don't think we expect there to be an outsized move in markets due to the midterm results. I think it's possible that just having these midterms behind us potentially could be a moderate positive just from not having that uncertainty. But it's definitely something we'll be watching closely and will be worth keeping an eye on next week. So with that, I want to thank everybody for joining Private Asset Management's Week in Review.
As we do every week, we'd like to encourage you to like our video on YouTube and subscribe to Private Asset Management's YouTube channel.
And if we said it many times before, but if you have questions, if you have topics that you would like us to cover in these weekly videos or another video series that we have planned for the future, please go ahead and email the email address that you see on screen, and we will see everybody next week.